Okay, everyone that's online for today's webinar, welcome to our retirement webinar, Stop Thinking, Start Planning. I'm David Maddock from Apt Wealth Partners. We're going to talk about retirement planning today and what that looks like. But in particular, we're going to be looking at with a focus on self-managed super funds. Why specifically self-managed super funds? Well, we've had a growing number of inquiries about self-managed super funds over the last couple of years in particular. And a lot of those queries stem from the fact that people wanting to take more control of their superannuation, understanding what they're investing in and making sure they're setting up for retirement and not just reliant on the standard approach to managing superannuation in retirement. All right, so a bit about me and why should be listening to me in regards to self-managed super funds and retirement planning. Well, I've 20 years experience in the industry. Self-managed super funds has been a growing area, and as I've just said, and over 600,000 self-managed super funds are now within Australia and over almost $1 trillion of assets. And I specialise in providing advice in that SMSF space and have done so for over 10 years. And so I've seen this applied successfully over 10 years for people managing their retirement, and happy to help anyone that's looking to use an SMSF that may be the best option for them in retirement or considering this option. So a bit of housekeeping today. There is a Q&A section on your on this Zoom. So if there are any questions, you can type that in. I'll look to address those near the end of the meeting. You'll also get a recording of today's presentation as well. So after the meeting, if there's something that you wanted to listen to or revisit, you will get a recording in a few days after today's meeting. And also feel free to share this content with anyone that you think may benefit from it. All right, important information. I'm only just talking general today, and you should be aware that a self-managed super and the retirement planning isn't a one-size-fits-all approach. So it is something that you're going to need your own specialist advice on. But I'll give you plenty to think about today and why an SMSF may be, as I said, a good option for your retirement planning. So the agenda, some of the things that we're going through. So, and this is not all just purely self-managed super fund related, but all the questions that generally people ask for retirement, and most of it is super related. So how much do I need to retire? What does retirement look like for you, and when can you retire? Understanding your investments in retirement, and that's where SMSFs are quite different. Maximising your superannuation. So how do I accumulate wealth in super for that one day when you do retire? Transitioning to retirement. So what does that look like? Are you going to just go cold turkey full time into just no, I've had enough and retiring, or transitioning to retirement over a period of time? Selecting the right partner. So, obviously we specialise in SMSF advice and how we may be able to assist you with your retirement and your super fund advice needs, and why Apt, what do we do, and how do we offer some benefits to clients and add value, most importantly, to your situation. This is a great quote that we often use with our clients. So at the end, you'll regret the things that you didn't do instead of the things that you did do. So for most people, I don't think most people, everyone in retirement, it's about doing those things that you may not have been able to do because you have been working, raising kids, paying off mortgages, and now you're at a point in time, hopefully, that you can start to enjoy the fruits of your labour, but also making sure you're managing your wealth so it lasts you and is there to do the things that you want to do and enjoy in retirement. So thinking about retirement here for a moment, 1 in 5 Australians think about retirement daily or often. And some of the things, what does it look like? Well, it is when is the right time? Will I cop any capital gains tax? How do I start a superannuation pension? How much will I need? Aged care, what does that look like? Eventually, if you have to move into aged care, and obviously the daunting task of how do you eventually afford that if you have to go down that path. Lifestyle changes, what can I afford to do? all those things, and how long will it last? Obviously, a big question, and what lifestyle will I have in retirement? So hopefully we can answer at least some of those things today in terms of, well, how do you structure yourself in a way that helps you understand your retirement and make decisions where you have confidence about spending money, say on a holiday, maybe gifting some money to kids, also, upgrading cars, things of those nature, all those larger decisions and how they may impact you in retirement. So the big question, how much do you need to retire? Well, it's often a big question people ask. They have no idea what that looks like. Some people think the 300, the 500, the 750, the mil or more. So, essentially 500,000, obviously that $500,000 is a good start. And then obviously 750,000, obviously the more you have in retirement, the better. But there are actually some statistics out there, which we'll jump to in a moment. So ASFA, they're a group that does statistics on a regular basis of what does it look like for structuring yourself in retirement. And this is 2023, so I dare say it's slightly more than this now in 2025. But when they last did this survey, couples 690,000 was required for a comfortable lifestyle in retirement, and for singles 595,000. Obviously, a single person, why that doesn't drop dramatically is, well, they still have the same often cost that a couple do in terms of housing, bills and things like that, but they're not sharing it between a couple. So obviously, needing a bit more. But obviously it does come down to the lifestyle that you want to live in retirement. A couple of the assumptions on this, in case you're wondering as well, it's based on age 67 and, receiving at least a part pension and a part age pension. So at that level of assets and superannuation, you would get still a part pension, depending on your assets outside of super. But that's seen as what's the amount needed for a couple for a comfortable lifestyle in retirement. And look, that 690 plus is starting to get to that realms and around that realms of considering a self-managed super fund as well. So the question would be, well, what type of income does that look like? So for a comfortable lifestyle, and that's what we're basing it on, is 52,000 just over, is seen as the comfortable lifestyle required, or a comfortable lifestyle for a single person, and for a couple just shy of $74,000 per annum. So say a couple, $690,000 per annum, with a portion from your super giving you an income, a portion from the age pension giving you an income, will give you a $73,000 to $74,000 income that's seen as comfortable. Obviously, that's an average. So some people will need a lot more than that. Some people, can live quite comfortably with that level of income. The modest lifestyle, so at the lower end, and if you've got less money in super, and depending on what money you need to live off in retirement, for a single, it's seen as 33,000, and for a couple, 48,000 as a modest lifestyle. But the big questions are, again, what does your retirement look like? And I sort of alluded to this just before. Some of the things are, travel plans, holiday plans, car upgrades or car plans, helping out children, which is the bank of mum and dad, is a growing thing that clients are often considering. If you've got a large family home that you've raised your family in, and now it's on a bit of a bit of land there, or a bigger house that you no longer need, a lot of the consideration is, do you downsize, and what does that look like, and does that help with your retirement planning? And obviously phasing out work. Do you, depending on when you want to do these things and these larger ticket items, do you stop work altogether? Do you phase out work over a period of time, reduce your hours, transition to retirement? And obviously all of these factors we discuss with clients to come up with your personalised financial plan, and what does that look like for you specifically. All right, so generally speaking, we see two types of retirees here at Apt, and the red line being your capital depreciating over time. So low income, a super fund, or eating into your capital on a regular basis to afford your retirement, versus The blue line, where obviously where we want to ideally have all clients, is that you are maintaining capital in retirement, living off your income, living off your dividends, living off rental or whatever it may be that you have as your income, and having control about when you're drawing upon capital or when you are realizing capital on selling shares, selling property, whatever that looks like in retirement. But ideally, we're wanting to keep everyone in that blue line, because obviously preserving capital, keeping your capital balanced there is what will really prevent you from running out of money in retirement. So the big question often is, how long my money lasts? Well, we can live off your income, living off the dividends, the interest, the rent for as long as possible from your investments, and let your capital grow and maintain value over time. You are very unlikely over the long period of time to run out of money in retirement. And that's really important, and why is that important? Well, number one, it gives you peace of mind, and that's how we work together with clients to hopefully stay on that blue line of maintaining capital. You live the lifestyle that you desire in retirement, and hopefully taking a lot of the stress out of retirement and stress out of big lifestyle decisions in retirement. So how do we work with you to do that? And the checklist on the right-hand side is maximizing your superannuation, tax-effective strategies, accessing government benefits where we can, and surviving market downturns. And lastly, making sure the income lasts a lifetime. So those last 2 points, in surviving a market downturns and ensuring your income lasts a lifetime, is really where I believe self-managed super funds are well structured to actually protect your capital long term. And reason being, which I'll explain in shortly, is that all superannuation accounts aren't the same, and there can be a vastly different between, say, an industry fund and a self-managed super fund on how you're drawing upon and using your capital in super in retirement. So where will your income come from in retirement? So the main two where clients will benefit from getting an income, firstly is the age pension. Okay, so the age pension is the government pension that will provide you a fortnightly income depending on your income and assets. So if you are under the asset test threshold at the moment, you do get at least a part pension. So just for those that aren't aware, it's just over $1 million that you can have, excluding the family home for a couple, and still at least get a part pension in retirement. So it is getting up there again where you can have quite a bit of assets and still get a part pension. But if you're over that $1 million, it's just $1 million and around about $50,000 you can have. And that's your cash in bank, superannuation, all your assets, excluding the home. You can still get a part pension for a couple there, and that's a different threshold for singles. But again, it can still be a fair bit of assets before you don't get any age pension at all. For those that are over the age pension limit, they are considered what's called self-funded retirees. You can still get some Centrelink benefits, whether it's concession cards in retirement, but you just won't get the full, or you won't get the fortnightly, age pension payments. Then you have your superannuation. Most people these days will have some level of superannuation, and obviously that's what I'll focus on predominantly today. How do you use your superannuation to provide an income in retirement? And obviously, how do you make that last? Savings, it's always important to have a cash savings buffer outside of superannuation in your plans for retirement. So you've got savings to draw upon for any emergencies. And lastly, most people, or some people at least, will have assets outside of superannuation, investments outside of superannuation. So that also comes into our planning. So whether you can transfer some of those assets into superannuation, which you can do with a self-managed super fund, whether it's shares, things like that can be used to support you in retirement, or just keeping outside of superannuation, shares and investment properties and the like will help. Obviously, all of this, if say dividends and rent, all helps provide a pool of income that helps provide an income for you in retirement. So Understanding your investments. This is where self-managed super funds can be vastly different to other super funds out there, and how you're structuring your superannuation for retirement. So I'll just touch on this chart for a moment. So I've been doing this for a while. I'm not getting any younger. In the last 20 years since I've been advising, we've had the global financial crisis. We've had COVID in 2020. I'll even chuck in Liberation Day there in early April, where the market was quite volatile. But over a 20-year period, we have had some big downturns, and we've also had some big upswings the other way as well. So volatility and market movement is a normal course of investments, share market returns, which does impact on superannuation and superannuation returns. So we do have to plan for these events as much as we can and protect you as much as we can. And essentially over the last 20 years, those big downturns of the GFC and particularly COVID obviously saw clients' returns and superannuation investments drop over that period of time. It's a stressful, daunting time for clients during that period of time. But if a history is going to repeat itself in the next 20 years, we'll say there's at least going to be a couple of events, whatever they are, that will have a big economic impact on investments and on superannuation, and that's going to happen. So how do we plan for that, and how do we manage that through retirement? Because most people are going to have 20 years plus in retirement, and how do we make that last? And that's what a self-managed super fund can help you do. Having said that, this chart will also show that, say, for example, you see there in 2008, the big drop in 2008, but then the big rebound in 2009. Sometimes it's going to be time in the market rather than timing the market. And any 1 year period of time, or any 12-month period, the share market can, on average, be down as much as 14%. And that's sort of seen as the average. But the majority of time, 22 out of the last 30 years, at the end of the 12-month period, the share market has been in a positive position over that period of time rather than a negative position. So again, it's not having all your eggs in one basket, having a good asset allocation, and making sure that you're structured your investments in a way to manage your superannuation through any share market or economic uncertainty. All right, so understanding your self-managed super fund investments, know what you own and have control. So this is the really big difference between a lot of superannuation funds out there and in industry funds. And I really do believe this is important to understand, is that you can actually own the likes of Commonwealth Bank, Bunnings, you've got CSL, Google, Microsoft. One that clients would have may have heard of recently is Nvidia. Has performed really well over the last 3 years, the biggest company now in the share market. You can in various ways get exposure into these types of companies through this Australian Stock Exchange. So you actually don't have to go overseas to invest in these companies, but you can actually, through a self-managed super fund and the ASX, invest in either exchange traded funds, directly held Australian shares, and know exactly what you're invested in. And that's important because, one, I see that gives clients a lot of confidence of knowing exactly how their money is invested. And then also they've got the transparency of knowing, say, example, if you have a self-managed super fund, it's Mr. and Mrs. Brown Super Fund, they can go to the share registry and see the Mr. and Mrs. Brown Super Fund has 100 shares in Commonwealth Bank. So you know transparently exactly what you are invested in, how you invested. And Commonwealth Bank, for example, that was $60 a share during COVID in 2020, now $170 a share. So living off the dividends and seeing that share market return and knowing that you've held those Commonwealth Bank shares through retirement has seen, many of our clients' capital appreciate, and also over that period of time, and also get a pension because they know exactly how their money is invested. A big part of that is also knowing how your cash and defensive investments are structured as well to insure you against a Liberation Day type event or a COVID event where the share market dropped as well. So you have a great deal of insight, transparency with your self-managed super funds, and you can know exactly what you invested in, which is very different to say just you're in the balance fund with an industry fund, for example, and you may have a little bit of an idea, but you have no idea exactly, what you're entirely invested in. And also, it's very transparent in that you will actually see the dividends coming through every 6 months. So you know the income from your portfolio, and you know the share market capital growth from your portfolio, again, which is very different from a lot of super funds. So how can an SMSF help you manage your retirement? Well, you can get greater control upon your investments. We've just discussed in retirement, and more control of preserving capital, right? So I'll talk a bit more about that in a moment and give you an example of what that actually looks like. You get the government guarantee on banks and term deposits for up to $250,000. So with a self-managed super fund, if you have a term deposit in your self-managed super fund, you are government guaranteed, just like any other bank term deposit out there, up to $250,000 per bank. So you can have that guarantee or that peace of mind that part of your defensive part of your investment is very safe, very secure, and government backed. You can decipher between the income generated from the super fund and the capital growth. And again, this is very different from most super funds out there. So you might get a super fund that says they've given a 7% return for the year, and they'll just tell you that's a 7% return. A self-managed super fund that's generated a 7% return, they might have got the exact same return, but you can actually break that down and say, well, 3% of that is dividends and interest and income, and then the balance is 4% is the capital growth. And that's giving you that 7% return. And again, I'll explain why that helps preserve capital and helps you stay on that blue line from that earlier chart of preserving capital, is because we want to draw from the income and let that capital growth and the growth continue throughout retirement. So that's a really important difference between a super fund, industry fund, and a self-managed super fund. You get to control over your dividends and the distributions, which can either fund retirement or be reinvested. So if you are not yet retired and you are accumulating wealth in super and a self-managed super fund, what you can do, Commonwealth Bank shares, using them as an example again, you can dividend reinvest those, or you can take those dividends to fund your retirement. So if you're dividend reinvesting, you can buy more Commonwealth Bank shares, and that helps with the compounding of returns leading up to retirement. Normally speaking, because we're drawing an income in retirement, we may turn that dividend reinvestment off in a retirement and start using that income. But you have the power and the discretion of working out how you're going to draw upon your retirement in super and in your super, either leading into retirement or post-retirement. You can take control over your capital when you realise capital gains, and control over your minimising tax on super. So again, if you wanted to, you can just pick parts of your portfolio. If you said I needed to, say, take out $30,000 from your superannuation for a car upgrade in retirement, you can specifically sell a portion of shares that's going to best suit you and preserving your capital, whether that's a company that has done really well and we would just want to take a little bit of that capital growth out of the share market, or if the share market's in a bit of a downwards trend at the moment and we don't want to take some money out of the share market, we can actually just, if we plan for this, take money out of cash, defensive investments, and then let the share market rebound to preserve capital. So we have, again, a great deal of control over when we're selling investments, which investments we're selling. We may want to keep one share and not sell that because it's doing really well, or we think it's going to pick up in the next 12 months, maybe, versus another company that we think, it's time to realize some capital on that. So again, we can make really informed, controlled decisions with your capital in retirement to making sure it's preserved. And ultimately, preservation means making sure you're least likely to run out of money in retirement and giving you ultimate peace of mind. This is another big advantage, and the full transparency of a super fund, a self-managed super fund, is that you get the full advantage of the franking credits generated from your portfolio. So what are franking credits? For those that don't know, franking credits is a tax credit, essentially for investing in Australian companies. So it's solely Australian companies, ASX listed companies, likes of BHP, likes of Telstra, likes of Commonwealth Bank. They pay a fully franked dividend, and that fully franked dividend gets passed on to the self-managed super fund. Again, if you are in accumulation, what we call it in our terminology, or still working, essentially the tax rate on your super is 15%, and you can then a 30% tax credit. So what does that mean? You can almost get your self-managed super fund, even leading up to retirement with those franking credits, into a low tax, close to zero tax environment, depending on how much tax you're paying on your super, but essentially getting a 30% tax credit that offsets the 15% tax in your super. All right, so that immediately offsets tax payable in the super fund. And then if you are retired and fully in pension phase, so what does that mean? It's 100% in a pension environment, paying you an income out of your super fund each year. You get the full refund of those franking credits, because you're in a zero tax environment. You actually get a tax refund every year, and we see that directly go into the self-managed super fund bank account. So again, very transparent. You're getting the full tax benefit and full tax credits of these franking credits, which is a unique feature to self-managed super funds. And you can also, should you choose, to own direct property in your self-managed super fund. So whether it's residential or commercial property, it is subject to some legislation or super fund legislation, which you need to be aware of. But it is unique to, again, self-managed super funds, that you can invest in residential, commercial property, direct property owned by your super fund. Say a commercial property, this is where I've seen it benefit some people that are still working and still a number of years until retirement, own a warehouse or a factory or a shed or an office block in their actual super fund, which their business rents back off their self-managed super fund. So can support you also your business or your wealth plans that way, should you wish to. All right. So using an SMSF to survive GFC 2.0. And this is the fundamental difference between, and when I say unitized fund there on the left-hand side, Max, the unitized fund, and Jane, her own investments, the fundamental difference between a self-managed super fund and an industry fund, and how it does protect and preserve your capital over the long term. So the scenario being the share market drops by half and then recovers over 5 years. Max on the left-hand side being a unitized fund. So just for simplicity, that's a industry fund. And Jane on the right-hand side, she has a self-managed super fund, and they both start with $1 million. All right. So pretty basic scenario there. Now, Max is taking $6,000 per month from his super. Jane is taking $6,000 a month from her super. They're both retired. That's what they're using off each year to live off each month to fund their lifestyle in retirement. Now, over that 5-year period, Max is in a balanced option, and he's taking out every month without him really planning on it, or may potentially even knowing it, is taking out about 70 to 60% out of the share market each month, because most balance funds will have about 60 to 70% of that allocation in a unitized fund out of the share market. So whether the share market's up or down, he's taking out, making a sell decision, turning on the tap and reducing his money out of the share market every month. Where Jane, on the other hand, we've put of her $1 million, we're set aside roughly about, say, $700,000 in shares, ETFs, managed funds, or whatever we've decided for her, particularly for the long term, and we haven't touched that over 5 years. The 300,000 remaining, because that's that 70% in the share market, the 300,000 defensively, we've been able to draw upon that and allow the share market to recover over that 5-year period of time. So we're drawn from cash, term deposit, defensive investments. And then that has seen eventually, after the 5 years, Jane is at $838,000, whereas opposed to Max in a balanced fund where he's drawing upon the share market every month, 375,000. So this is vastly different. And this is what the concept that a lot of people don't understand about in retirement, understanding how am I drawing my income and where's it coming from each month to provide me an income in retirement. So I'll spend a bit more time on this because this is a bit really important to understand, is that what it allows you to do is actually make sure, though we're talking about decision making, is being able to make sure through economic cycles that you're not having to draw upon your shares at the wrong period of time. Now, if I use COVID as an example, the share market dropped dramatically in March 2020. If you was also planning to buy a car at that period of time and planned for that and took another $30,000 out and also continue, say in Jane's case, $6,000 per month, that has a dramatic impact on capital if you're also having to sell shares at that period of time, because you're actually not being able to get the rebound of the share market. We know over the long term, and we say long term, 5+ years, and even greater over 10 years, that the share market over a 10-year period of time is always higher, historically has always been higher over a 10-year period of time. So it's making sure that we're not having to draw capital or draw upon your shares at the worst possible time to give it a chance to rebound and preserve capital. Again, I'll use Commonwealth Bank as an example. It was $60 in March 2020. Today, it's $170 a share. If we're able to not touch Commonwealth Bank shares, which a lot of our clients have in their self-managed super fund, and allow that just to grow over that period of time, live off the dividends, live off not having to sell the Commonwealth Bank shares over that period of time, it dropped, but it's rebounded, and that's seeing clients' balances. And pretty much all of my clients that I've got long-term clients over 10 years, if they've just drawn the regular amount out and having to take any large lump sums out, their capital has been preserved over that 10-year period, despite having a COVID event, despite having a liberation event, despite a lot of the unknowns. Now, the reason why this is important again to understand is there's two systems working in play here. You've got the superannuation system, that you are forced to draw an income out of superannuation in retirement. Having said that, you've also got the superannuation, so the share market system, and that will keep on doing what it does no matter how your superannuation is structured. All right. So essentially being able to understand how you're drawing upon your capital, and then also how your share market performs and how they intersect into your decision making in retirement, allows us to make decisions that can preserve capital by drawing upon investments that aren't going to blow up your portfolio in a downward market. And that's where self-managed super funds, in particular in a downward market, preserve your capital a lot better than a fund where you can't pick and choose what parts of your portfolio you want to draw upon. And we can make really strategic decisions that help preserve capital. All right, we'll move on. Maximising your superannuation. So in terms of how do you maximise your superannuation and why build up wealth in superannuation in the first place for retirement, and then how do you do that? Well, superannuation allows you to tax effectively save for retirement. So it reduces tax on your personal income. The earnings are tax effective. It's a forced savings for retirement. So live for today, plan for tomorrow. You'll see there, that's one of our plans, or sort of our mantras here at Apt, is that we want to put some money away for tomorrow, but also live for today. So getting that balancing act right. It can be an effective estate planning tool, and it's in retirement. You can get the only tax-free income that you get is superannuation in retirement from age 60, and up to $2 million can be in a tax-free environment for you. So it's a really good way of putting money away tax effectively for retirement. And as I said earlier, you can support if you're in that sort of growth mindset still in your accumulation for retirement, you can own a commercial property or properties that may suit your business in retirement. As part of your retirement planning as well. Superannuation contributions. So how do they come in? All right. So you've got concessional contributions and non-concessional contributions. So I'll talk about concessional in the blue box there for a moment. So if you're an employee, 12% of whatever you earn goes into super, and the employer pays that for you. Okay. On top of that, you can actually salary sacrifice. This is an additional amount that you pay above your employer contributions into superannuation, and that is up to a limit of $30,000 a year. If you do salary sacrifice, that helps reduce your personal income tax. So depending on what marginal tax rate you're on, so just assuming, say, 30%, which a lot of people are on the 30% tax bracket, if you then salary sacrifice money into superannuation for retirement, you reduce your tax payable by half, because the superannuation tax is 15. So you've got a 15% tax saving straight up on any contributions that you salary sacrifice up to $30,000. I will just state the $30,000 limit does include what your employer pays. So if your employer puts in $10,000 into super for you, you can salary sacrifice up to $20,000, allowing you up to that $30,000 limit per annum. That's each financial year. Then you have the non-concessional contribution in that yellow box. That is any contributions that you want to pay into superannuation after tax. All right. So this isn't a tax deduction, but it's money that you may have accumulated either from an inheritance, from savings, from selling an investment outside of superannuation, and you just want to put that away into superannuation for retirement. You can do that. And in down that bottom right-hand corner, you'll have total non-concessional up to $120,000 a year. Okay. Subject to your super balance being less than $2 million. So there's a little bit of a limit there on how much you can contribute if you're on a larger balance. And you can trigger what we call a bring forward rule, or a 3-year bring forward. So you can put either $120,000 a year or up to $360,000 in one lump sum. That's using the 3 years, this financial year and the future 2-year limits, contributing to super to get larger lump sums into superannuation per person. Also, what comes into that is the government co-contribution and spouse contributions. Okay, so you have a limit on how much you can put in each year, but a much larger limit, and that helps you tax effectively in the long term, say for retirement. Doesn't give you a tax deduction up front like a salary sacrifice concessional contribution does. So the benefits of a concessional contribution, as I said a moment ago, from that 34% tax bracket, you're on that $45,000 to $120,000. That's the 34.5%. The concessional rate is 15%. You get a 19.5% tax benefit. I was saying 15%, but essentially 19.5% tax benefit there. And then as you go up your income levels, you save more and more tax. It is a little bit different for people above the 250,000. There is what's called the Division 293 tax. So it reduces a bit to 17%. Again, we can provide advice on what's the best way of setting yourself up for retirement for those larger incomes. But really, anyone from $45,000 or above, there is a significant tax saving. Even on the higher tax rate, it's still 17% tax savings by putting more money into super and claiming it as a deduction. So definitely something to worth thinking about if you can afford to do so. All right, so understanding superannuation. So on the left-hand side, you've got accumulation, and in the middle there, you've got pension. And then I said I kept on using that word accumulation. That's what we call clients that are still in that working phase, still building up money in superannuation for retirement. That's accumulation. You're accumulating wealth. That's 15% tax. As soon as you are at least age 60, or up to age 65, depending on whether you're retiring and what age you are. If you meet a condition release and convert your accumulation super into a pension super account, you move to a 0% tax environment. And so that's that real tax effective savings that I was talking about, is because you can accumulate in that pension account per person up to $2 million, and it'd have a 0% tax and pay you a tax-free income in retirement. So if you're saying drawing say $70,000 a year out of an income tax-free in retirement, you're looking at a $100,000 plus type income, employment income, that you would be normally earning to generate that level of income. So you've got to say $100,000, pay 30%, $30,000 in tax. That leaves you net $70,000 of income. You've got a $70,000 tax-free income in retirement. So it's, you can generate a really good tax-effective income for you. On the right-hand side, this is the really important part. And I'll stay on this for a moment, because again, this is where self-managed super funds can really benefit you. Minimum annual pension payments. So between age 60 to 65, you are forced, if you're in a pension phase, to take a minimum of 4%, 65 to 74, 5%, and 75 to 79, 6%. And then as you get older, you can see the way superannuation is designed, those pension accounts, you have to take a greater income each financial year. Not each depending on what age you are, but incrementally as you get older, you're going to have to take more and more income out of that 0% tax-free environment. So how do you preserve capital? Again, in retirement, say for example, you're 65 to 74, you actually, whether you want to or not, if you want that tax-free environment and tax-free pension, which I'd advise you best to do, you have to take at least 5% out of your superannuation each year. All right. Now, whether you've got a 10% return or a negative 5% return, you still have to take 5% out each year. It's not linked to the return. It's linked to your superannuation balance. All right. So what we want to do is try to, as much as we can, plan how we're drawing upon that 5%. We don't want to have to be forced to sell shares to pay out that 5% in a declining interest rate environment, or declining superannuation share market environment. We want to preserve your capital as much as we can by having a structured way of drawing upon your superannuation. Okay. And a self-managed super fund allows us to be very strategic, and also allows us to be very strategic on how do we actually generate, say, a 6-7% return, ideally, which a balanced type of client can generally achieve, to at least cover your 5% return each year. And again, if we can get a 7% return and then we're drawing 5% each year, you are very unlikely again to run out of money in retirement, because the returns are covering the pension that you're forced to take out each year. Okay. And then as you get older, we plan around, well, how are we going to do that? And if you have to force to sell shares, you're at age 80 to 84, you're having to take 7%. You may have to sell down some shares over time to afford to pay that pension. Again, we want to do that in a structured way. Now, the reason why you're forced to increase as you get older is the government doesn't want you leaving large amounts of money in superannuation in retirement. Okay, they want you to use that money for funding retirement. Okay, catching up on superannuation contributions. Now, this can be quite powerful. So if you are under $500,000 in your superannuation and you haven't maximised your concessional contributions in previous financial years, and that at the moment, as we said, that's $30,000 this year. Say, for example, you only put in $10,000 this financial year and you could have put $30,000, and you're below $500,000, in future financial years, you can go back and use that $20,000 amount. It's like a catch-up amount that you can use to build up your superannuation if you haven't maximised your super in previous financial years. So a bit of a busy table here, but in this example, you can see they paid the blue on the left-hand side, $15,000. They did put some contributions into super for a couple of financial years, and then another $15,000 in the 23 financial year, and $10,000 in the actual 24 financial year. Then, so the unused amount was 10,000, then the year after 35, then it's grown to 62,500, 75,500, and then the 2024, $107,500. So though you got the $30,000 annual limit, if you haven't maximized it in the previous 5 financial years, you can put a catch-up amount, in this case, in this scenario, of $107,500 into your superannuation, and that can significantly reduce your tax. And particularly if you had a high income year, or if you come into money, this is a really tax effective way of saving money for retirement. And the savings on this level of contributions, $107,000 tax deduction, can be absolutely massive. All right. So if below 500,000, you've got a bit of money for whatever reason, it's definitely worth thinking about, because we can save you thousands of dollars in tax by taking advantage of this quite powerful strategy. All right, so tax advantage, take every opportunity. There are a couple of little tweaks as well that you can make, that they all make a difference to your longer term retirement planning. The government co-contribution, the spouse tax offset. So for lower income earners, so below 62,000, you can still put $1,000 into super and get a $500 matching co-contribution payment from the government of up to 50% of your contribution. So that's the $500. And if you have a low income earning spouse below $40,000 of income, and you put in a $3,000 spouse contribution, that spouse that contributed that amount gets a $540 tax offset. So essentially for $4,000 into superannuation, you can get a $1,040 benefit for your super and your tax. So again, really tax effective little thing. If you do over a number of years, that they all make up a difference. Downsize of contributions. So for the last few years, since 2022, you have been able to make a downsize of contribution into superannuation if you just downsize your home. So we have a number of clients, as I used an example earlier, they're in a bigger home, the kids have moved out, they're empty nesters, they're in a big house. They're sort of talking about retirement planning. What should we do? You can put money into superannuation up to $300,000 each, and it won't count towards that non-concessional cap or the $2 million accumulation balance that we've talked about. There's the limit that you can contribute. So this, in additional to the normal superannuation contribution rules, you can put money into superannuation and put it away for retirement. And the only thing to be aware of is that the house isn't assessed by Centrelink for age pension purposes, but as soon as you sell it and free up some capital from downsizing and putting that money into superannuation, it does become an asset that's counted by Centrelink. Okay, but and the main thing to also be aware of with this downsizer contribution, it has to be your principal place of residence for at least 10 years. And there are some criteria that you have to meet in terms of getting contributions in a relatively timely manner if you do this. So again, if it's something you're interested in, you do need advice around that to get that done right. All right, so using a self-managed super fund to protect your beneficiaries. So there's a couple of things, binding death nominations and estate planning for your superannuation assets, and then also a recontribution strategy we'll talk about as well. Firstly, just with the self-managed super fund, and they can also be quite a good vehicle for transferring assets on to next generation. Couple of reasons they are good, depending how much you want your kids and your family involved. Your children can potentially be a part of your self-managed super fund as well. So depending on the family unit and how involved you want to be as a group, you can have up to 6 members in a self-managed super fund. So that could be potentially mum and dad, and say up to 4 children. Could be part of a self-managed super fund, and then also part of that they have an understanding of mum and dad's superannuation, make some decisions about how that flows on to the next generation. Now, binding death nominations, we normally would recommend binding death nominations. They are binding the trustees or the people in charge of the super fund to pay out based on whatever decisions that member of that super fund has made. Also, which is something that most super funds don't allow, that a self-managed super fund does allow you to do, is in the event of a, say, husband and wife passing away at the same time, there's option 1 and then option 2, which is really good. So if say the super is supposed to go to the wife or the wife's to this husband, they both pass away. Obviously, that nomination doesn't really make sense anymore. It does have the option of, okay, if that's the case, then option 2 is pay to the children, pay to the estate, pay however, that individual person wants the next flow of assets to go on, is an option 2 in the second instance. So you can have a payout order of number 1, husband, wife, number 2, children, or wills, or however that's to look like, which is a flexibility that a lot of clients do appreciate, because the reality is, unfortunately, sometimes these things do happen, and it's good to have some backup plans there as well. Recontribution strategy. So in my case, I use myself as an example. My mum and dad, I'm not dependent on them. If I inherit wealth from their superannuation, and that's where most middle-aged people, if they inherit, they're not dependent on their parents any longer. They can actually pay up to 17% tax on inheriting their parents' super. So I'll just read that out in that box there. Superannuation benefits inherited by non-dependent children. So again, that's probably most adult children, will attract tax payable up to 17% on superannuation payments. Now, if I just use a $1 million super balance, depending on how that's structured and what we call the components behind the actual super fund, which a lot of people aren't quite aware of this, that could be 17% on $1 million, $170,000 in tax. So we're not talking about a small amount of tax here that's paid before the children will benefit from your superannuation benefits. So a recontribution strategy, which I'll talk about in a moment, can help significantly reduce that amount of tax. So a recontribution strategy allows us to restructure your superannuation in a legal way, in a way that reduces tax, but it's totally above board, to make sure as much as we can, we reduce that, in that particular scenario, $170,000 in tax. All right, so protecting your beneficiaries, what does that look like and how does that work? So I gave an example just a moment ago with $1 million, but say Jane and Tom, they're age 63 and just retired. Jane has $660,000 in her account-based pension. So it's all in Jane's name, all contributed by her employer. So what that basically means, that $660,000 would be 100% taxable if paid on to the children. Tom, her husband, has no super. So once once Jane and Tom pass away, Jane's children, the kids, pay 17% tax on the remaining funds. That's $112,000 on $660. So again, no sort of minor amount there. That's a significant amount to have to pay before your kids get that benefit. So what we can do there in that instance, I've got a slightly different figure here, but Jane has met a conditional release. She could draw up to $720,000 of her superannuation tax-free and recontribute that back $360,000 using those limits back to Tom, and because he has no super, and $360,000 back to Jane. And so essentially $720,000 goes back to her children tax-free, saving again a significant amount of tax in retirement. On her estate. So essentially what it basically means is we can put money out of your super, put it back into your superannuation, and we can do that really quite tax effectively, and also reduce the tax on your superannuation when paid to the estate. Now, I've done this for a number of self-managed super funds. Again, a really good thing that we can do with self-managed super funds If we have to take money out of superannuation purely for the purposes of reducing tax on your estate, we don't have to sell shares to do this. We can take, okay, if you've got, say, $120,000 worth of cash in your super, we can take that cash out and do that a few times, three times to get up to 360,000 without having to touch the share market and investments in the superannuation. So we've been able to get money out of super, recontribute that back to super, save significant amount of tax on the client's inheritance to their children without having to touch the shares and sell the shares to do that and be out of the market or impact any capital gains or anything like that that may trigger tax issues on actually using your superannuation to contributions to reduce this tax significantly. So again, these are some things that you can't always easily do with normal funds. Again, you take a balance out, you take 360 out, you're taking out of the share market, you're putting back into the share market, you're in and out. Things can happen quite dynamically on the share market. If you miss out on a couple of those better days of the share market by doing these strategies, where we can strategically do this for you very effectively with a self-managed super fund, it makes a lot of sense to use that type of facility to make this work. I should talk about Division 296 tax. So if you're not sure what Division 296 tax is, you've possibly heard of the proposed legislation for $3 million tax on super balances above $3 million. It actually hasn't been legislated yet. We're expecting that it will be legislated in some shape or form. And that's obviously where we're looking at this very closely. Basically, if you're not aware, there is looking at, and this is all super balances, whether a self-managed super fund or not. Again, it's balances above $3 million, you're actually going to get potentially taxed for an additional $3 million, additional 15%, so 30% tax on anything above that $3 million threshold. Now, again, a self-managed super fund can be used to, if we have to sell down some investments to pay this tax, again, we can be very strategic about that, particularly for those that are in accumulation still. So that means you haven't met a conditional release, you can't take money out of super, you can't make any adjustments, you're going to have to wear this tax. But again, we can be very strategic about how we manage this tax. Again, we can have some cash term deposits put aside in preparation for potentially paying tax, or if we do have to sell some shares, we can pick and choose which shares we need to sell to do that, rather than just taking realizing capital gains when we don't want to on your super. For those that are in retirement and can access superannuation and take lump sums out, we're coming up with a number of strategies that may benefit you. So that can be a little bit what we talked about, a recontribution there for a moment for estate planning. Well, it may be recontributing and putting into a lower spouse's super if they've got a lower balance below the $3 million. It may be benefits to take money out of superannuation if you're over the $3 million threshold. What do we do potentially with that money outside of super, whether that's investing in another form, whether that's a family trust. I've seen some articles about what's called investment bonds as well, which you may have heard of, which is another investment structure. Again, a bit like self-managed super funds, there's not a one-size-fits-all approach. And with Division 296 tax, there's not going to be a one-size-fits-all approach either, because it's going to be dependent on your individual circumstances of what's going to be best. Okay, transitioning to retirement. So, retired, now what? You can't play golf 365 days of the year. So retirement is always an easy transition. So it is also a psychological transition. We've talked about the hows a little bit and some of the things to think about. But retirement, is something where you are also making a decision around, well, what does your lifestyle look post-employment? So with this emotional transition, as we call it, you do need a plan, and I'd say advance of actual making a decision on retirement, what activities you want to do in retirement, the social connection that you want to basically maintain, accomplishment, the things you want to accomplish in retirement, because generally speaking, you're always looking to, if you're a career-minded person, accomplish things in your retirement. Now you don't have that need to get up for work and to things to accomplish in the day, you know, what are you going to replace that for, you know, hopefully maybe things that are even more fulfilling for you. But, you know, getting a sense of accomplishment and still working towards things and doing things that will really add value to your life in retirement. What purpose or direction you want to take. You know, I've heard that, you know, purpose-driven life. What type of purposes do you want to maybe support, or what you want your retirement to look like? Time structure. You know, again, if you're working 9 to 5, Monday to Friday, you have a very structured time. Now, what's it look like in retirement? And also, you know, particularly I've seen it with some of our, you know, career-minded clients that have, you know, been high pressure, high status jobs. All of a sudden, you know, it might be a bit quieter and in retirement, and you know, how do you get that sense of purpose in retirement if you're not having the same need to get up and energy levels that you might need in retirement? In work, how do you continue to make sure you're thriving in retirement? Okay, investing in the future starts with choosing the right partner. Obviously, at Apt, you know, we partner with a lot of clients with self-managed super fund and retirement planning. Just to give you purely, you know, some of the statistics here in the Geelong office here, we manage over 70 clients in a self-managed super fund space. So, and we're getting inquiries regularly about more and more people reaching out about self-managed super funds. Why is that the case? Well, clients are really wanting to take more control and having a bit more peace of mind about their retirement. There are surveys that have been done in the industry that say clients that have a self-managed super fund with advice have significantly better peace of mind and comfort and confidence about what their retirement looks like, and understanding and know exactly how they're positioned for retirement, and it gives them confidence. So Apt as a business is a national firm. We're privately owned. We're self-licensed. We don't have our own products at all. So essentially, that's why, you know, again, a self-managed super fund isn't product related. It isn't product driven. It's really client related, and it's strategically driven towards what, you know, is going to help best the clients. We service over 3,000 families across Australia, $3 billion in assets under management. So, you know, that's self-managed super funds, that's other investments, that's you know, wealth accumulated across our clients that we help manage. We've got a Sydney, Melbourne, Geelong office. You know, based in Victoria between the Geelong and Melbourne office. We have a large number of staff across those 3 offices, but do assist clients in, you know, all across Australia with their self-managed super funds. If you're looking for advice, but you're not a self-managed super fund person, or not interested in that, but we're looking to take a bit more ownership of your super, we still do that. We're not everyone's a self-managed super fund candidate, but we do believe they can be powerful for the right person and right people. But, you know, if there's other areas you're looking for advice, we do provide that. There's some of our community support groups that we support, a number of charities there that we're passionate about, and we have recently got a number of awards over the last 2 to 3 years recognised for our work across the industry. So SMSF services, what do we do? So obviously some of the things that we try to do is making sure, number one, you're understanding your investments, maximising your retirement income, government benefits, making that emotional and financial transition, surviving market downturns, and ultimately, hopefully, living the lifestyle you want in retirement and having that purpose in retirement that you're really wanting, and hopefully helping you do that. And that's one of the reasons why I really enjoy what I'm doing and have done for, you know, 20 odd years now, and like 10 years as an SMSF advisor. It's been really great to see clients, you know, going on those holidays, helping out grandkids, helping out kids, living that real desired lifestyle that they want to, and seeing the fulfillment they get out of that. And that's really because they have got the confidence of being able to help out and do what they want to do, because they know the financial side is taken care of. In terms of myself, again, senior financial advisor and partner of Apt with the self-managed super fund specialty. We also do have a legal team that has worked really well with our estate planning plans, Some clients still want insurance, and it might be appropriate to have insurance through their self-managed super fund. We of the life insurance, income protection, all through Apt as well. And we partner with our accounting firms, and we have that in-house as well, where we can get you some accounting services that do all the financials for the super fund. You don't have to organise that. We do that for you. And so really, you don't have to be looking at the share market daily. You don't have to be understanding all the ins and outs. We work with you to give you the confidence of knowing what you own, making strategic decisions, but also not having to panic about knowing what's happening every single day and organising all that's entailed with the self-managed super fund, because essentially we do that for our clients. All right. Now you've taken the first step. Let us join you in the journey. So there's a number, our email address. Feel free to reach out. Feel free to watch the video at your leisure that you'll get after today's meeting. And if there's any questions after that, or anyone that you think that's interested in talking about self-managed super funds, always happy to have an initial discussion with people and see if it's the right fit. Okay, I might just ask, there's one question here, or a couple of questions that I'll just briefly, has been lodged, and then I'll leave it there. There was one question, and the gist of it is, essentially is, I'm looking to retire in the next 2 to 3 years. How would I preserve capital for clients in retirement, using in a self-managed super fund? So I'll just use the example of $3 million. Sorry, $3 million, $1 million in superannuation, and drawing an income of $70,000 a year. What I'll be doing in the lead up to retirement is with that particular client, and I should say, it does say, given the share market's an all-time high at the moment, is we know that the share market's done really well. We know that there's going to be peaks and troughs. Is actually putting in the vicinity of about $250,000 to $300,000 defensively invested for that particular client. And they'll be starting to do that now. The share market's at a high point, and putting that into, say, cash term deposit type environment, or at least having part of it in that type of environment protected. So that's 2 to 3 years worth of pension payments without having to worry at all about the share market over the next 2 to 3 years, and even longer, say the next 5 years, in the lead up to retirement for that particular client, so that they can let the share market do what the share market does, and not having to panic. I'm about to retire today, the share market's dropped 10%, now I'm drawing an income. I've already planned for that well in advance, so they're not having to sell out of the shares or manage their superannuation capital in a way that's going to blow up their portfolio as soon as they are in retirement. If there's things they're wanting to spend on early in retirement, like say a car or a holiday, again, we'd plan for that with their self-managed super fund portfolio. So hopefully that makes sense. That's it for today. If you've got any questions, don't hesitate to reach out to myself. We've got advisors all across Melbourne, Sydney, Geelong. Again, particularly I'm happy to help with self-managed super funds, and all the best for your retirement plans. Thank you.